My name is Dawit Kebede, Senior Economist at America's Credit Unions. Welcome to the Economic Update. With so many questions about the economy and how Americans are dealing with it, it's worth looking at credit risk and how credit union members are holding up near the end of summer. But first, let's step back and look at credit risk from a wider perspective. We see here there is historical relationship between unemployment rate and credit union delinquency. Normally, we see rising delinquencies when people lose their jobs. During periods of rising unemployment, families face reduced income and must make difficult choices about which bills to pay first, or pay at all. Most choose to prioritize housing and utilities over loan payments. But we have noticed a different situation in the last 3 years. The job market is strong, yet more people are falling behind on payments. The rise in delinquencies is particularly high for two types of loans: credit cards and auto loans. For credit union auto loans, 60-day delinquencies have reached levels we haven't seen since before the pandemic. Credit card delinquencies are even worse. They are now higher than what we saw during the Great Recession. We also track 90-day delinquencies reported to Equifax. These serve as an early warning for charge-offs. About half of the loans that are 60 days late become 90 days late. The pattern is similar across both loan types. The good news is that 90-day delinquencies remain lower, which predicts lower charge-offs ahead. This is particularly important for auto loans since they are collateralized. If loans do reach the charge-off stage, net losses will be much lower due to vehicle recovery values. This raises an important question. Why are delinquencies rising when the labor market is close to full employment? Are loans made after the pandemic different somehow? Especially considering credit unions experienced record growth in lending during 2022. To answer this question, we conducted a vintage analysis. This method tracks loans by the year they were made. Our analysis tracks accounts that are more than 60 days past due by origination year. The charts show cumulative delinquency rate. This means we count any loan that ever became delinquent, even if the borrower caught up later. This measure indicates the extent of overall struggle in payment, capturing the full picture of member financial stress, even when they eventually become current on their accounts. The results are striking. Loans made after 2021 perform much worse than older loans. Auto loans from 2022 and 2023 experienced payment problems twice as often compared to pre-pandemic loans after 2 years on the book. Credit card loans from the same period had 50% higher delinquency rates. We also looked at point-in-time delinquencies. This measures only loans that are currently behind on payments. It excludes accounts that became current after falling behind. This metric considers the resilience of members despite a period of difficulty in late payments. It could also serve as a testament to credit unions helping their members become more resilient through financial counseling and workout programs. The graph shows a similar pattern of rising delinquencies for post-pandemic loans. However, there are some positive signs. The data suggests delinquencies may be cooling off or stabilizing after 2 years on the book. Credit card delinquencies appear to peak between 1 and 2 years after origination. After that, they decline. This current view looks better than the cumulative measure. Many households received multiple rounds of government stimulus payments during the pandemic. According to a Federal Reserve study, some used this money to reduce their debt burdens. This led to widespread improvements in credit scores across the population. But what happens when artificial credit score boosts disappear? We examined the credit score distribution of auto loan and credit card loans from 2022 and 2023. Then we compared these scores as of June 2025. A large proportion of loans in both categories went to members with 660. Many of these borrowers have since moved one or more credit tiers. For example, 51% of auto loans were extended to members with a 720 credit score or above in 2022 and 2023. While 80% of these members stayed in the same credit score category currently, the remaining 20% have moved down in score. In summary, credit unions saw record loan growth in 2022, but it appears that these loans behave differently from pre-pandemic loans and contribute to higher delinquency. High interest rates and an increasing cost of living also makes this situation more complex, even with the labor market close to full employment. While cumulative delinquencies look concerning, current portfolio health shows signs of stabilization if the unemployment rate holds relatively steady. Thank you for watching this economic update, and we'll see you next month.